Hi, this is Mike Nicholas, the mortgage professor, and I wanted to have a little conversation today about interest rates, specifically mortgage interest rates, and how inflation and the 10-year Treasury bill are interrelated to what's going on and what we might be able to forecast as we approach the summer purchasing season. So to do that, I'm going to share my screen for a moment and hopefully be able to go over some charts that I've created that will explain some of this to you in a more logical format. So let's try it. So basically, what's going on with interest rates is a function, or mortgage rates is a function of past Fed decisions. Specifically, the Fed decided to do quantitative easing when the economy was locked down in the spring of 2020. And they continued to hold that quantitative easing position all the way up until January of 2022, approximately a 18-month period. And what that did was that artificially held down mortgage rates at a time when inflation started taking off. This red line is the inflation line, and as you can see, it took off quite dramatically. So when they removed quantitative easing, that meant that interest rates for mortgages also rose quite dramatically and peaked in November of 2022 at about 7.125%. Since that time, we've been in a position where the Fed has been raising the Fed funds rate, and by raising the short-term rates, they're attempting to stamp down this pink line, this ugly core inflation line. So here's how it basically looks. Every month, because the Fed doesn't know how to add and subtract, or excuse me, doesn't know how to multiply and divide, they can add and subtract, but poorly. They're all C- students. They take off the inflation figure for 12 months ago and replace it with the current month. So if 12 months ago the core inflation figure was a 0.6, they would take that off and they would replace it with whatever the number is for January of 2023. Well, when they do that, they have components within the cost of funds. And one of those components is the housing component. And the housing component has been a very difficult period. So as we're projecting forward, the anticipation is for the core inflation rate to come down. But part of the difficulty in having it come down is that the shelter cost has continued to rise. And the shelter cost is approximately 40% of the CPI. So you might ask yourself, well, why is that? And the reason why is because a large part of shelter costs is rents. And so you have people that did a rental, let's say in June of 2021 or July of 2021, and that rental rate continues to July of 2022. Well, these folks that paid these incredibly high rental rates in January of 2022, those are just now being renegotiated. So as you can see, the cost is coming down, but the average shelter cost has continued to rise because of this huge bubble in rental rates during the prior period. So shelter costs really are right around here, but we're still measuring. This chart measures it as if you're in the last car of the roller coaster, which isn't a very comfortable place to be. So what does that all mean when you apply it to Treasury bills? Well, the 10-year Treasury bill tends to track with inflation, and mortgage rates tends to track with the 10-year U.S. Treasuries. The 10-year U.S. Treasury is the cost to the government to borrow money for a 10-year period. This particular bond is auctioned monthly, and then the yield is traded on the open marketplace. So the public, basically you and me, or smart investors that are working on our behalf through our pension funds and things like that, are buying those 10-year treasuries. Well, this blue line is the normal 10-year treasury rate. The yellow line is the 30-year mortgage rate. And as you can see, there's a correlation all the way along. But whenever we reach periods where there are spikes, the average yield spread of 1.75 to 200 basis points, or in other words, 2%, is exceeded when rates shoot up quickly. So here we have a situation where the 10-year T-bill started dramatically taking off. And so as a result, the cost of mortgages also took off very aggressively and very steeply. And we, as I mentioned already, peaked in November of 2022. Since that time, these two lines are turning, but understand that the reason why it expands kind of like an accordion is if we're not sure what rates are going to be in the future, the servicing value of a mortgage for the person that's collecting the coupons goes down. So when they don't think it's going to stay on their books for 7 to 10 years, they want it in yield because they're not going to get a service margin. So anytime rates are going up, that accordion expands. When rates come down, it slowly comes back into alignment to get back to that average of 1.75 to 200 basis points. There are two other things that are going on right now with the economy that have a big impact on people's ability to buy and what's going on with housing. These two charts are not in the same time frame, so you have to look at the gray line on each to match them up. But what I want you to see here first is that credit cards were going along, growing at a slow but steady pace as people take on consumer debt and more people come into our economy. But when we hit COVID, that dropped dramatically and credit card debt went down and stayed in basically the cellar for almost a year and a half. But in the past 12 months again, that credit card rate has accelerated very quickly. And now consumer debt is well above what it was 3 short years ago. At the same time, the savings rates, which were averaging 10%, shot up to where people had a much higher percentage of personal savings as a result of those stimulus monies put in the bank accounts for a temporary period. And since then, the public has slowly but surely, with the exception of additional federal stimulus spikes, tended to spend away all that savings. And we now have a lower savings rate than we had prior to the pandemic 3 years ago. So lack of savings combined with credit going to high levels, which are going to mean that people are going to start hitting their credit limits. And that means they're not going to be able to buy it as steeply in the future. Both of these are contributing to the change in consumer habits. And eventually we're going to see people diminish their spending. Another thing that's going to impact that, of course, is jobs. And we're all hearing anecdotal evidence of job activity. What else tells us there's a recession? Well, the last item that tells us a pretty clear indicator of a recession is anytime we have an inverted interest rate curve. Remember, nobody borrows money cheaper than the federal government. So when the federal government normally goes out and borrows, they'll borrow for 3 months, and let's say it's a cost of 0.5%. But then when they go to borrow on a 10-year, it might be at 3.5%. That's an interest rate curve, normal interest rate curve. What we have now is the opposite of that. The treasury rates for the 10-year treasury are today at about 3.8. 2 short weeks ago, they were about 3.5. They've been as high as 4.2. So it's choppy, but the point is they're averaging around 3.5 to 3.75, and the 3-month treasury bill is actually between 4.25 and 4.5. So the government can borrow money cheaper for 3 months. Nope, that's not right. That's normal. The government can borrow money cheaper for 10 years than they can for 3 months. And that's backwards, or what we call an inverted interest rate curve. And that's typically an indication of a recession. In fact, each and every time that you see one of these gray bars, that was a period just after or during an inverted interest rate curve where we had a recession. And we are headed severely down into that territory right now, which is a precursor to our next recession. And that recession could come as soon as this fall or as late as into next year, but it is coming. It's unavoidable based on these numbers. That brings me to my final chart that I want to share with you, and it'll kind of explain what's happened with mortgage rates in past recessions and in times like these with an inverted interest rate curve. This is from Freddie Mac, a buyer of mortgages, and it goes all the way back to 1971. And as you can see, every single time, whether it was 1980, 1982 to 84, 1991 through 93, 94, 2002, and again in 2009, each and every time we've had a recessionary period, and we've had an extremely long period without a recession until the COVID recession, which was short in duration. But each and every time when you have a recession, interest rates peak and then come down. And so this is the peaking of the rates in 2022, and we expect interest rates to drift lower as we proceed through the rest of 2023. Now, I know I threw a lot of numbers at you. I know this is a lot of charts, but what I really wanted to do was explain to you as best I could what's going on with interest rates. And more importantly, let you know that the Mortgage Professor tracks this each and every day, and that my capable team here at Integrity Mortgage, my loan officer associates, Sean Witten and Michelle Kincaid, as well as the rest of the team, they monitor this with me because we want our clients to know and rest assured that we're tracking this to put you in the best possible position for your initial mortgage and also to improve that position when the time is appropriate. So thank you so much for taking the time to watch this video.